We are looking at a really mixed tape at the closing bell today. The Dow closed up about 0.30%, settling around 53,436.
Right.
But the S&P 500 actually fell 0.26%, and the Nasdaq took a pretty solid hit, dropping around 1%.
Yeah. And the bond market is just screaming right now. The 10-year Treasury yield is sitting up at 4.70%.
Which is huge. And we had some wild single stock movers today, too. I mean, Marvell Technology jumped like 9.6%.
While NVIDIA and Micron both took serious hits.
Exactly. And we also got some international earnings from PDD Holdings and XPen, plus that Chicago Fed economic data release.
Right. There's just a massive amount of data to process from today's session.
So usually we try to move briskly through these daily stories, keeping it tight and just reading the tape. But today the tape is just completely broken by these massive macro shocks.
It really is.
So we are throwing out the standard playbook today. We're going to do a massive deep dive into our source material to figure out exactly why the stock market is so bifurcated today.
Yeah, because you can't just look at the stock tickers in a vacuum right now. You have to look at the causality.
Right. So we have a huge stack of sources classified Treasury memos, global shipping data, think tank commentaries, and those corporate earnings reports.
And the overarching theme you really need to keep in mind as we go through this is that everything is connected.
Geopolitics dictating the supply chain, right?
Exactly. The geopolitical aggression dictates the supply of goods. And then that supply of goods dictates inflation.
Which freaks out the bond market.
Right. And the bond market dictates whether your high-growth tech stocks crash or soar.
Oh.
So if you don't understand that very first domino, the rest of the board just looks like total chaos.
Well, then let's start with that first domino, which is firmly planted in the Middle East.
Yeah.
Because before we even touch a stock ticker, we have to talk about what Treasury Secretary Scott Bessent announced today regarding Iran.
Right. He called it an economic onslaught.
An economic D-Day. I mean, we're in the 6th month of the war now, and this is a massive escalation from the U.S. Treasury.
The official name they're using is Operation Economic Outcast. And Bessent did not mince words at the podium today.
Oh, I didn't.
He framed this as an extreme economic coercion campaign, acting on direct orders from the White House to basically force the reopening of the Strait of Hormuz and just starve the Iranian war machine of capital.
And the administration's rhetoric is super confident right now. We saw posts on social media this morning claiming Iran is completely collapsing.
Yeah, they've been saying the regime is on its last legs for a few months.
But this action from the Treasury today feels, I don't know, different. They are targeting secondary sanctions across digital assets, gold, aviation, tech, and shipping.
It's a huge dragnet.
But for someone listening who, doesn't work at the State Department, what is the actual mechanical difference between a primary sanction and a secondary sanction?
Oh, it's basically the difference between a boycott and a total blockade.
Okay, break that down.
So a primary sanction means the U.S. government just tells American companies, you cannot do business with Iran. That's straightforward.
Right. We just wall ourselves off.
Exactly. But a secondary sanction is where the U.S. leverages the total supremacy of the U.S. dollar.
Okay.
The Treasury goes to the rest of the world and says, if you do business with Iran, you cannot do business with the United States. And you absolutely cannot use the U.S. dollar clearing system.
Wow. So you have to choose.
Right. You can have access to the U.S. consumer and our banking system, or you can trade with Tehran. You cannot have both.
And since the U.S. dollar is used in, almost 90% of global foreign exchange transactions?
Something like that, yeah.
Getting cut off from that system is basically a death sentence for a multinational bank or a huge global shipping company.
It is, and Bessent made that explicitly clear. Any entity facilitating money laundering for Iran gets removed from the dollar system. He literally said the clock just started ticking.
But wait, how do they actually enforce something that massive?
That's the tricky part.
Like, if a shell company in Dubai is buying Iranian gold and they use crypto, how does the Treasury track that, let alone stop it?
It's incredibly complex, but they enforce it through this massive web of intelligence and correspondent banking.
Okay.
Because even if a transaction happens in crypto or a foreign currency, eventually those assets have to interact with the legitimate global banking system to actually be useful at scale.
Right, you have to cash out eventually.
Exactly. So the Treasury's Office of Foreign Assets Control, OFAC, They track maritime insurance on shipping vessels. They track SWIFT messaging data between banks.
And when they find a discrepancy,
They don't just find the tiny shell company. They go up the chain to the massive global bank that processed the transaction, and they threaten them.
which is terrifying for those banks. And we're already seeing this happen, right? Earlier this month, they levied sanctions against companies they claim laundered hundreds of millions of dollars.
Yeah, they hit Shar Bank and exchange houses in Dubai like Titan Exchange and Alps International.
They are actively hunting down these shell companies in Hong Kong, Singapore, the UAE. But this is where it feels really risky to me.
How so?
Bessent actually stood at the podium today and criticized countries that are trading with Iran. He specifically called out U.S. allies in the Persian Gulf,
Yeah, he accused the UAE of appeasement.
which is wild because the UAE just formally suspended financial and economic transactions with Iran last week.
It's a fascinating diplomatic choice, to say the least.
They're trying to comply, and we are still publicly berating them. And he didn't stop there. He fired a warning shot right at Beijing.
Right, he warned Chinese banks that are financing Iranian oil imports,
He said flat out, no one is above the reach of U.S. sanctions.
which is playing for the highest possible stakes.
Exactly. If we cut major Chinese banks out of the dollar system, doesn't that just accelerate their push to build an alternative currency system?
Oh, absolutely.
Aren't we just shooting ourselves in the foot by weaponizing the dollar this aggressively?
That is the exact debate happening in macro circles right now. When you threaten the financial arteries of the world's second largest economy, it's, well, Brett Erickson from Obsidian Risk Advisors put it perfectly in one of our source documents today.
What did he say?
He called it a very dangerous game of chicken. He pointed out that the core constraint here is the appetite for mutual destruction.
Right.
If the U.S. isn't actually willing to target the largest Chinese state-owned banks, because doing that would trigger an overnight global financial crisis.
Oh, it'd freeze global trade instantly.
Exactly. So if they aren't willing to do that, then these threats are largely rhetorical.
Ah, I see.
And Erickson asks, if they are just rhetorical, can Washington really justify damaging relations with vital allies like the UAE for a strategy that might not even collapse the Iranian regime?
It feels like a huge geopolitical bluff, like holding a live grenade and hoping the other guy blinks first.
It is a bluff, but it's a bluff with real-world friction. Even the threat of these sanctions forces shipping companies to reroute. It forces insurers to hike premiums on cargo,
Which makes moving goods more expensive.
which feeds right into inflation.
And speaking of friction and supply chain disruptions, we really need to pivot to the north. Because while they're declaring an economic D-Day on Iran, the administration just fired a massive economic missile at Canada.
Yeah, the term unprovoked might be debated by the administration, but the scale of this is totally unprecedented.
Unprecedented doesn't even cover it. Over the weekend, the U.S.-Canada trade talks completely collapsed.
And at 12:01 a.m. on Saturday, a 50% tariff on roughly $20 billion worth of Canadian goods officially went into effect.
50%. That is not a small adjustment. That's an astronomically high tax at the border.
It really is.
I mean, if a U.S. company imports a $100,000 piece of Canadian machinery, the government is slapping a $50,000 tax on it.
And we have to remember the history here. For 80 years, this was considered the closest, most integrated economic partnership on the planet.
Our economies are so intertwined.
Deeply intertwined, especially in manufacturing and raw materials.
The administration's defense is that Canada has been discriminating against U.S. exports, right?
U.S. Trade Representative Jameson Greer said Washington offered reductions on existing tariffs, but Ottawa walked away.
They're specifically mad about alcohol, dairy, and automobiles.
Yeah, they argue American producers are being denied fair access. And to be fair, Canada's dairy market runs on a very strict supply management system that heavily protects their domestic farmers.
Sure, and the U.S. has complained about that for years across multiple administrations.
But the escalation here is what is shocking the markets today.
Right, because these new 50% tariffs apply even if the goods meet the strict origin rules of the USMCA.
Exactly, the United States-Mexico-Canada agreement. They are basically overriding the free trade agreement that they themselves negotiated and signed just a few years ago.
It's wild. Now, they did carve out some exemptions, didn't they?
They did. Energy is excluded, which is vital because the U.S. imports massive amounts of Canadian oil and natural gas.
Thank goodness for that.
They also excluded potash for fertilizer, fish, and critical minerals.
But even with those carve-outs, that $20 billion hit covers construction cement, lumber, wine, household electronics, even hockey equipment.
And Canada is not taking this lying down.
No. Ottawa's response was immediate and fierce. Prime Minister Mark Carney came out and stated Canada is becoming stronger and less dependent on America.
He promised dollar-for-dollar retaliatory tariffs starting September 8th.
September 8th. That's right after the Canadian Labor Day holiday.
It's very deliberate timing. And they already published their target list.
What are they going after?
U.S. steel, dairy, appliances, agricultural equipment, pulp and paper, electronics.
Wow.
Canadian economist Christopher Reagan was quoted this morning calling it a policy tantrum and made it clear Canada's not going to cave.
But let's look at the mechanics of that retaliation, because this is where the splash hits the American heartland.
Right.
If Ottawa targets U.S. agricultural equipment and dairy, they are hitting the exact constituencies that traditionally support these America First trade policies.
And we are exactly 10 weeks away from the midterm elections.
It's a huge political risk. Are we just playing global whack-a-mole here?
It's a massive political gamble, and the internal blowback within the U.S. is already intense and totally bipartisan.
I was looking at the press releases today. Republican Senator Susan Collins from Maine is warning about devastating costs for businesses in her state.
Because Maine shares a huge border with Canada.
Exactly. And then you have Democratic Governor Gretchen Whitmer in Michigan calling it a direct tax increase on families.
She's worried auto companies in Detroit will have to cut jobs because their supply chains run back and forth across the Ambassador Bridge every single day.
The auto industry is so integrated.
Right, a car part might cross the U.S.-Canada border 6 or 7 times before the car is finally assembled.
Gee.
If you tax that component at 50% during one of those crossings, the cost of the final car just skyrockets.
Vermont's Republican Governor Phil Scott flat out said, Canada is not our enemy.
The border states are up in arms.
But it's not just the border states. California and Kentucky are going to feel it when Canadian government-controlled liquor stores boycott U.S. wine and bourbon.
And the U.S. Chamber of Commerce is practically begging the administration to restart negotiations.
Because fundamentally, these Canadian imports are mostly intermediate goods, right?
Exactly. They aren't finished products sitting on a Walmart shelf. They are raw materials, lumber, aluminum that American companies use to build things.
So if you tax the materials, the cost of manufacturing the Made in America product goes up.
Which means the price tag for the American consumer goes up.
Right.
The administration can argue they want fair access to Canadian markets, sure. But if you pick a fight with China, alienate the UAE, blockade Iran, and slap punitive tariffs on Canada all at the same time.
You risk a massive, synchronized global supply shock.
Exactly. And a supply shock is the purest fuel for inflation.
Which brings us perfectly to the financial plumbing of the United States. Because that inflation monster is currently terrorizing the bond market.
Oh, absolutely.
We have to look at how the government is funding itself in this inflationary environment, because the national debt just crossed a staggering $40 trillion.
$40 trillion. To understand the anxiety on the trading desks today, you have to look at the raw numbers.
Like we mentioned in the open, the 10-year Treasury is at 4.70%.
And the sovereign bond market is the bedrock of global finance. It sets the baseline price of money for the whole world. And right now, that price is uncomfortably high.
The 30-year bond recently hit a 19-year high, touching 5.34% before settling around 5.23 today.
Right.
For our listeners who don't watch the bond market every day, why are yields that high on government debt such a massive flashing warning sign?
Let's break it down. When you buy a U.S. Treasury bond, you're lending money to the U.S. government.
Okay.
The yield is the interest rate they pay you for taking on that risk.
Yeah.
Now, U.S. debt is usually the safest asset on earth.
Sure.
But when yields spike over 5%, the market is demanding a much higher premium to hold that debt.
But why? Are they actually worried the U.S. will default?
No, it's not a fear of default. It's a fear of devaluation.
Oh, interesting.
It's these macro forces colliding. First, persistent inflation from the supply shocks we just talked about. If inflation is running at 3% and a bond only pays you 2%, you are literally losing purchasing power.
So investors demand a higher yield just to beat inflation.
Exactly.
Yeah.
And then you have massive deficit spending.
The $40 trillion debt.
Right. The government is borrowing aggressively. When they issue a massive flood of new bonds, the supply goes up. To attract buyers, they have to offer higher interest rates.
It's just basic supply and demand. If you want to sell 1 billion apples, you have to drop the price of the apples.
Yes, and in the bond market, when the price of the bond drops, the yield goes up.
Got it.
And on top of that, we have heavy corporate debt issuance and what analysts are calling the global savings squeeze.
I read about this in one of our sources. Former Fed Chair Ben Bernanke used to talk about a global savings glut in the 2010s, right?
He did.
The idea was that foreign countries had so much excess cash they just poured it into U.S. treasuries, which kept our interest rates artificially low for a decade.
That was the reality.
Yeah.
But that glut has evolved into a severe squeeze.
What changed?
Well, think about it globally.
Mhm.
Sovereign debts are rising everywhere, not just here. International trade is fractured, so countries are hoarding capital.
Right.
You have aging populations in Europe, Japan, and China driving up pension and healthcare costs.
And the AI sector.
Exactly.
Yeah.
A booming, hyper-capital-intensive AI sector, sucking up hundreds of billions of dollars for data centers.
So everyone, governments, corporations, AI startups, aging nations, they're all sitting around a table fighting over a shrinking pie of available dollars.
Precisely. Everyone wants to borrow money at the exact same time. When demand for capital outstrips supply, the cost of that capital, the yield goes up.
Okay, so yields are soaring. Interest payments on my $40 trillion debt are skyrocketing.
Yeah.
And Treasury Secretary Scott Bessent looks at this math and decides to do something completely unorthodox.
Highly aggressive.
Yeah. He doesn't just accept the high yields. He announces a move to physically force those long-term interest rates down.
Last week, the Treasury announced it would double its buybacks of long-dated bonds.
We're talking securities with maturities of 10 to 30 years.
Right. They are committing to a minimum of $4 billion per buyback operation.
Walk us through the math there. How does the government buying its own debt lower the interest rate?
By stepping into the open market and buying their own long-term debt from investors, the Treasury artificially increases the demand for those specific bonds.
And when demand goes up, the price goes up.
Yes. And since bond prices and yields move in opposite directions, as the price rises, the yield falls.
Mhm.
They are actively trying to put a ceiling on how high the 10-year and 30-year rates can go.
But this is the part that made me do a double take this morning. How are they paying for these buybacks?
This is the crazy part.
You can't buy billions in bonds with good intentions. Reports say Bessent is tapping directly into the Treasury General Account, the TGA.
Right. The TGA is basically the U.S. government's checking account held at the Federal Reserve.
Where tax receipts go.
Exactly. It's where the money comes from to pay the bills. And currently, that account holds nearly $1 trillion in cash.
Wait, normally, if the Treasury wants to buy back old, expensive debt, they would issue new, cheaper short-term debt, like T-bills, to fund it, right?
Normally, yes.
But Bessent isn't doing that. He's just taking cash directly out of the government's checking account to buy the bonds.
Correct.
If the Treasury is using its checking account to buy its own long-term debt to force interest rates down, aren't they basically acting like a central bank?
That is the exact comparison Wall Street is making today.
It feels like taking a cash advance on one credit card to pay the minimum balance on another credit card just to manipulate your credit score.
It's exactly like that, but with a terrifying twist. The entity issuing the credit card also owns the printing press.
Wow.
So the risk isn't just a bad credit score, it's undermining the currency itself. Analysts are terrified about the erosion of institutional firewalls.
Break that firewall concept down.
Traditionally, there is a strict firewall between fiscal policy and monetary policy.
Okay.
The Treasury handles fiscal policy. They collect taxes, spend money, and issue debt. The Federal Reserve, an independent central bank, handles monetary policy. They set interest rates to maximize employment and control inflation.
The Treasury writes the checks. The Fed sets the cost of money.
Exactly. But Bessent is blurring that line. By targeting specific interest rates on the yield curve, he is doing the Fed's job.
Right.
Krishna Guha, a former New York Fed official now at Evercore ISI, wrote a really stark note in our sources today. He said, "We are in a regime where activist Treasury policy is as material as central bank policy."
Which sounds dangerous if you want an independent economy.
The risk is immense. By taking cash from the TGA and pumping it into the open market, the Treasury is injecting massive liquidity. It's stealth quantitative easing.
But wait, if they inject all that cash, doesn't that just create more inflation? And isn't inflation the whole reason bond yields are high in the first place?
Yes. That's the paradox. It might provide temporary relief to bond yields, but it raises fears of a weaker U.S. dollar.
A flood of dollars dilutes the currency.
And a weaker dollar makes every import more expensive, which feeds right back into unanchored inflation. It's a vicious cycle.
And this unprecedented move puts the actual Federal Reserve in an impossible position.
Very awkward position.
The Treasury is basically doing the Fed's job, but doing it in a way that risks inflation, which leads us directly to the tension building ahead of this Friday.
Right.
New Fed Chair Kevin Warsh is about to make his highly anticipated debut at the Jackson Hole Economic Policy Symposium.
Jackson Hole is the blue ribbon event of the year for central bankers.
The theme this year is financial innovation, implications for payments and policy.
But nobody cares about the payments papers? Every eye is on Warsh's Friday keynote.
Because Warsh is a very different kind of central banker. We got used to Bernanke, Yellen, Powell. They love to communicate.
Warsh has a deep distaste for forward guidance.
Meaning, he hates telling the market what the Fed plans to do months in advance.
Right. He doesn't want to spoon-feed the markets. He thinks telegraphing every rate move in these hyper-analyzed press conferences creates fragility.
He wants the free market to set the yield curve organically based on data.
Which is a respectable philosophy, but it crashes into reality today. How can Warsh let the free market set the curve when Bessent is manipulating the long end with a $1 trillion checking account?
He can't. It's a complete contradiction.
Exactly. Gua pointed this out too. Warsh wants to be hands-off, but the Treasury is stepping in with massive buybacks. It creates a glaring conflict.
The Treasury is stepping on the gas with liquidity, and the Fed is supposed to hit the brakes to fight inflation.
Right. And Warsh is under incredible political pressure from all sides. Senate Democrats are launching inquiries into his private calls with President Trump, questioning his independence.
And Trump has a long history of demanding the Fed cut rates to juice the economy.
But the economic data does not support a rate cut at all.
Not if you follow the Fed's mandate. Inflation is above the 2% target.
And the prediction markets know this. Polymarket sees the probability of a rate cut by October at a tiny 4.4%.
Wow.
And Kalshi shows traders believe a rate hike by December is 4 times likelier than a cut. They have the odds of a hike at 53.5%.
So the market actually thinks the Fed might have to raise rates again.
Yeah. And Minneapolis Fed President Neel Kashkari was out this weekend downplaying the panic over yields. He said 5% yields are historically normal, and he prioritized inflation control.
He's basically saying, let the yields rise, we need to kill inflation.
Right.
So what does this mean for Warsh on Friday? If he refuses to spoon-feed the market, won't traders panic? And if the Treasury is pumping liquidity, doesn't Warsh have to signal a rate hike to counter it?
He is walking a microscopic tightrope over a volcano. He has to establish his independence from the Trump administration.
To prove he isn't taking orders.
Right. He has to address the multi-year uptrend in interest rates, acknowledge the era of cheap money is over, and clarify the stance on sticky inflation.
All without triggering a market meltdown.
If he sounds too hawkish, tech stocks tank. If he sounds too passive, the bond market revolts because they think he's giving up on inflation.
Friday's going to be a masterclass or a disaster.
Exactly.
But let's bring this down to earth and back to those opening numbers. We've talked about global trade wars and trillion-dollar Treasury maneuvers. How are stock prices actually reacting?
Let's start with the economic thermometer from Main Street. The Chicago Fed National Activity Index, the CFNAI, came out today.
And it wasn't great.
No, it pointed to a distinct deceleration. It pulls 85 different economic indicators. A reading of 0 is historical trend growth. Positive is hot, negative is cooling. In July, it dropped to negative 0.08.
Down from an upwardly revised positive 0.06 in June.
Right. We flipped from above trend to below trend in 1 month. Weakness was broad-based slowing manufacturing, declining corporate capital expenditures.
Businesses aren't buying new equipment.
And a sharp consumer pullback. The American consumer is finally exhausting their savings.
But to be clear, negative 0.08 is not a recession.
Right. Crucial distinction. The true recession trigger is when the 3-month moving average drops below negative 0.70.
Okay, we are far from that.
We're only at negative 0.04, so no recession. Just a cooling, decelerating physical economy.
Okay, consumers are stressed, factories are slowing, but then you look at the stock market bifurcation today. The Dow rose 0.30%, but the Nasdaq dropped over 1%.
Right.
If the economy is slowing, why did the Dow go up while the Nasdaq tanked?
The Dow survived because of a massive rotation into defensive stocks. When investors are terrified of inflation, tariffs, and rising borrowing costs, they don't want speculative high-growth companies.
They want mature businesses that generate cash today.
Like the credit card giants. Visa was up 3.1%, MasterCard up 3.3%.
Why do they do well with inflation?
Tool booth business models. They take a percentage of every transaction. If inflation makes groceries 10% more expensive, the dollar amount swiped on Visa goes up 10%.
So revenue goes up without extra work.
Right. And there are software networks. They don't need massive capital expenditures subject to Canadian tariffs.
But tech companies, especially in AI, definitely require massive capital expenditures.
Exactly. And that's why semiconductor stocks drag the Nasdaq down today. It all comes back to the bond market.
How does a high treasury yield physically cause a tech stock to drop?
Discounted cash flow valuation. High-growth tech companies are valued based on profits projected 10 or 20 years out.
Right.
To figure out what future profits are worth today, analysts discount them using an interest rate based on the 10-year Treasury yield.
So if the treasury yield goes up, the discount rate goes up.
Yes. And the present value of those future profits shrinks drastically. Higher borrowing costs mechanically compress growth stock valuations.
It makes investors super sensitive to any uncertainty.
Right. If an AI company borrows billions at 6% to build data centers, they better prove they can generate profits fast.
And we saw that anxiety play out in the chip makers. Micron plummeted 5.8%, AMD fell 3.5%, Intel dropped 3.1%.
Even NVIDIA dropped 2.9% today, right ahead of their highly anticipated Wednesday earnings report.
Everyone is holding their breath to see if AI spending is actually translating to sustainable revenue.
Exactly.
But Marvell Technology jumped 9.6% today. How does a chip company surge nearly 10% when the rest of the sector is getting crushed?
Two specific catalysts. First, they are being added to the S&P 500 index, replacing Campbell Soup.
Trading canned soup for AI networking chips.
It's a sign of the times. And when a stock gets added, passive index funds are forced to buy shares, creating massive guaranteed demand.
Makes sense.
Second, Marvell provides the networking infrastructure that connects AI processors. Investors believe they are riding a structural tailwind immune to macro shocks.
So we have an economy cooling down, according to the Chicago Fed, yet Marvell surges on AI hype while other chip makers tank.
It's a wild disconnect.
The market is violently repricing supply-side risk from tariffs and sanctions, but remains totally undecided on economic growth.
Right. Punishing companies that need cheap debt and rewarding those with immediate cash flow like Visa or structural monopolies like Marvell.
And this tension isn't just domestic. Look at the Chinese earnings today.
Yeah, PDD Holdings, the parent of Temu, they reported Q2 earnings. Revenue was 112.4 billion RMB, an 8% increase.
Top-line growth is there.
But the stock reacted poorly because net income actual profit fell 12%.
How do you grow revenue 8% but lose 12% in profit?
Operating expenses, they rose 13%. Temu is spending billions on global advertising to fight Amazon and Alibaba. They were buying growth, but squeezing their margins.
Generating more cash, but costing exponentially more to get it.
And we saw the exact same thing with XPeng, the Chinese EV maker. They delivered over 103,000 vehicles. Revenue surged 51.5% quarter over quarter.
A huge jump, but let me guess. The bottom line is ugly.
Yes, they still reported a net loss of 1.34 billion RMB.
Selling 100,000 cars and still losing money.
Because the global EV market is brutal. Domestic price wars in China, looming tariffs in Europe and North America. It perfectly mirrors the U.S. tech sector.
The price of growth is just becoming astronomically expensive everywhere.
Exactly.
Okay, let's summarize this massive causal chain. We started with geopolitical shockwaves, Operation Economic Outcast against Iran, and 50% tariffs on Canadian goods.
Both act as massive supply shocks threatening to ignite inflation.
Then we followed that inflation threat to the bond market, pushing long-term yields to multi-decade highs, leading the Treasury to manipulate interest rates using a $1 trillion checking account.
Which perfectly sets the stage for Fed Chair Kevin Warsh's impossible tightrope at Jackson Hole this Friday.
And finally, we saw how that macro tension is tearing the stock market in two, the Dow rising on defensive stocks while the Nasdaq gets hammered by high bond yields.
And this is why listeners need to pay attention. The 10-year Treasury directly dictates your mortgage rate. Canadian tariffs impact the price of goods on local shelves. The repricing of tech stocks hits your 401k.
The macro environment is the water we swim in.
Absolutely.
So to wrap up, I want to leave you with one provocative thought. If the U.S. Treasury successfully uses its massive cash reserves to take over managing long-term interest rates through buybacks, does the Federal Reserve eventually become irrelevant to the broader bond market?
That is a chilling hypothetical. If the Treasury manages the yield curve alone, the Fed loses its primary influence.
Could the world's most powerful central bank be reduced to just tinkering with overnight rates while the Treasury dictates the cost of capital for the globe?
Definitely something to ponder ahead of Chairman Warsh's speech.
Indeed. Well, looking at tomorrow's calendar, keep an eye out for consumer confidence numbers and more retail earnings. Make sure to follow the show for daily market coverage. Thanks for diving deep with us today.